am an assistant director in GAO's Forensic Audits and Investigative Service. It is my pleasure to welcome you to today's event featuring sovereign wealth funds, corruption, and other governance risks, which is an insightful examination of these issues published last year through the Carnegie Endowment for International Peace. Joining us today is one of its authors, but before I introduce her, I need to share a few housekeeping notes. Today's event is sponsored by the Intosai Working Groups on the audit of extractive industries and on the fight against corruption and money laundering, and also by GAO's Federal Lands and Waters, Energy Transition, and Illicit Finance Communities of Practice. This event is being recorded and will be available for later viewing. And finally, be sure to enter your questions into the chat so that we can pose them at the end during the question and answer portion. So now a bit more about our featured speaker. Lakshmi Kumar is the former policy director at Global Financial Integrity and is an adjunct professor at Georgetown University. She's also been a senior fellow at George Mason University, as well as a lawyer and policy professional in India, working with governments and regulatory agencies across Southeast Asia, East Africa, and Eurasia to investigate money laundering and terrorist financing risks to their financial systems. Lakshmi, thank you again for joining us. The floor is yours.
Good morning, everyone. If you're on the East Coast, it's raining and it's cold, but I hope for wherever else folks are joining that it's much better weather. This was just to sort of start off, the idea of sovereign wealth funds was something that fascinated us because there's recognition that they account for such large pools of money, but that there is little in the way of questions that are raised about, are they money laundering and corruption risks? And this largely came from the ideas that every time we look at sovereign wealth funds, especially post the financial crisis of 2008, because there was so much sovereign wealth capital at the time deployed to save large swaths of economic sectors, both in the US and Europe. The view has always been that sovereign wealth funds, understandably, are a national security risk because there is a worry that adversarial interests to a country can acquire and control key economic assets. But moving beyond that, there is a question there, beyond a national security risk of an adversary acquiring key economic assets, is there a larger question of whether the money that comes in is inherently illicit, corrupt, problematic, which in other ways can exacerbate national security risks and exacerbate governance risks when you're looking at this from a whole of government approach. And starting with that question in mind, my co-editor of this compendium wanted to sort of look at a set of examples because we recognize that sovereign wealth funds, when functioning well with appropriate rules, are an useful vehicle for wealth generation across generations and a good way for countries to make use of natural resources and preserve them for future generations in a way that is meaningful. And we see so many successful examples of this overseas. Norway is a premier example of a national level sovereign wealth fund that has preserved revenue taken from extraction and has used it to create a fund where, by some estimates, some people say that every Norwegian citizen is a millionaire as a consequence. In the US, we have similar examples in Texas and Alaska and Canada that are well regulated. But since the genesis of sovereign wealth funds have now become almost a fashionable entity to set up and organize, because it's like, oh, if you find natural resources, let's set up a sovereign wealth fund. But for a sovereign wealth fund on its own cannot safeguard and preserve wealth unless it is supported by pillars of good governance and strong rule of law, which is our takeaway from this, from our analysis. And so the idea that a sovereign wealth fund surrounded in a sea of corruption, poor governance, fragile states, or the absence of rule of law will be unable to secure funds and maintain funds for the state long term. When it operates in such circumstances and under such constraints, what you really then see is that in many cases, it heightens the risk for money laundering, corruption. In some cases, it means that there are no questions asked about how you access those funds, and it can function in the most egregious of examples as essentially a personal piggy bank. And which is what we really chose to examine. And the report, which I know it is long, but I highly encourage you to read, brought together authors from all over the world through various disciplines to look at this. And so we examine both extractive funds, but as well as non-extractive sovereign wealth funds, because really that's where a lot of sovereign wealth funds and the nature of what constitutes a sovereign wealth fund has drastically shifted since the early 1950s. And so this report also touches on different parts of the world. It looks like at the African continent, we have Angola and Equatorial Guinea. We look at sovereign wealth funds in the Middle East. We look at sovereign wealth funds in Europe that have governance risks, sovereign wealth funds in Eurasia, and sovereign wealth funds in Asia as well. So there's also, we examine the Chinese sovereign wealth fund in the context of the Belt and Road Project. And there are various types of governance risks that they all pose. But now to get into the heart of the presentation itself. Sovereign wealth funds have existed for more than a century, and typically a sovereign wealth fund is a state-sponsored financial institution to manage a country's budgetary surplus. It accrues profit, and it is used to protect a country's wealth for future generations. Now, sovereign wealth funds can be set up in a couple of ways. You can typically set them up as a separate legal entity through a statute, where you're creating a sovereign wealth fund, which is distinct and separate, and the management of that sovereign wealth fund is governed by the terms of the statute. It can be set up as an account in a separate, through the central bank, which you see examples of that, like Norway is an example like that. Singapore is another example of that. Alternatively, sovereign wealth funds can just exist as part of like a state-sponsored entity. So sovereign wealth funds really take on various forms. What is interesting is in the 1990s, sovereign wealth funds only accounted for about $500 billion in assets. But by around 2020, they held about $7.5 trillion in assets, which is equal to about 7% of the global assets under management, which is about 111.2 trillion. Prior to 2010, there were only 58 sovereign wealth funds in the world. Today, we have seen an explosive growth in the number of sovereign wealth funds that are being set up, and many for the best of reasons, which is because we have seen success in the past with strong institutional frameworks, how sovereign wealth funds have been a vital and important way to shepherd resources into the future. But today there are about 118 operating or prospective sovereign wealth funds. So what this explosion is particularly noticeable in the African continent, where because of the nature of how the economy has worked, it is primary commodity export driven, by which I mean there is a heavy reliance on the extractive sector. And so in the context, and this is not to say that it's a problem that you've seen this explosive growth in the African continent, but rather that this explosive growth has occurred while risks to rule of law and corruption risks have not necessarily changed in that same time frame. And so it has created a situation where there are concerns or heightened risks about moving this pool of money into one institution when there aren't concomitant reforms designed to ensure that it will be protected. Since the early 2000s, 16 new sovereign wealth funds have been set up in the continent itself. And if you can look at this, the next slide here, it really shows you what the breakdown looks across time periods. So you can see that prior to the pre-1990s, about 28% of sovereign wealth funds were set up. Between 1990 to 2010 plus, you can see the explosion with the particular growth now seen between 2000 onwards, and it's ever growing. This number we see at 27% is an ever growing number and is likely to only increase. This is really a breakdown of how we see sovereign wealth funds in the African continent. And you notice here, so one of the first sovereign wealth funds to be set up was the Algerian sovereign wealth fund. Botswana, which is also one of the, what I would argue is a great example of a well-functioning extractive-based sovereign wealth fund that relies on petroleum, was set up early. And a large part of this is because the Botswana has had a stable government, strong rule of law, and has had relative peace since its independence. And that's really what has marked sort of the successful maintenance of its sovereign wealth fund. Soon after that, you have seen sovereign wealth funds pop up in Gabon, Equatorial Guinea, Libya, Mauritania, Ghana. And you can see that you have now a bunch that have popped up that have been prospectively being set up. What is of particular interest here, I will say, is you look at the examples of Equatorial Guinea and Libya. The Libyan Sovereign Wealth Fund very famously was subject to several lawsuits because it was subject to several, it's an extractive-based sovereign wealth fund, but is now under UN strictures because of the conflict in Libya. And it's a great example of the poor management of sovereign wealth funds. Considered one of the it is still, even with UN sanctions and strictures around the use of the funds, the Libyan Sovereign Wealth Fund remains along with the Algerian fund, the wealthiest sovereign wealth funds on the continent. The Equatorial Guinea Fund, which came up a little bit later, is also an extractive sovereign wealth fund. But what is interesting, even though it is, as far as the continent is concerned, one of the earliest sovereign wealth funds, the ongoing issue has been the lack of data. And this is a recurrent theme for us when we talk about governance and corruption risks, is that unlike other financial institutions or other types of financial institutions where there are clear-cut obligations on how sovereign wealth funds should be maintained and resourced, how financial institutions should be maintained, the disclosures they have to be made, how they are supervised. Sovereign wealth funds typically are allowed to operate in this environment of opacity. And there are good arguments for that. People have said that because it's a government institution and a state-sponsored institution, the investment strategies have to be protected because it functions similar to other private pools of capital. And you see this typically with, private equity funds, venture capital funds that involve high net worth individuals, and therefore the way they distinguish themselves and distinguish their profit-making strategy is by having that investment strategy kept secret. Disclosure of that arguably makes them lose their competitive edge. But at the same time, private pools of capital in many parts of the world are subject to good governance practices. They're subjected to anti-money laundering and counter-financing terrorism laws, which acts as a check to ensure that you don't see the unabandoned, unchecked use of illicit money. What is different between private pools of capital and a sovereign wealth fund is that sovereign wealth funds have a fiduciary responsibility to its citizens because they have stated objectives, typically that are along the lines of preserving wealth of future generations, economic development, ensuring that they can help stabilize the economy in times of crises. Because this creates a fiduciary responsibility, and yet at the same time, sovereign wealth funds, in terms of their operation and supervisory expectations, really do not operate outside of any checks and balances. In many of the cases that at least we covered in our compendium, it creates this perfect storm where it creates very heightened risks for corruptions, poor governance, and in some cases, money laundering. The Equatorial Guinea Fund is a great example because natural gas was discovered in Equatorial Guinea in 1983. Production began in 1992. And gas production, natural gas was in 1992, oil production in 1996. The Fund for Future Generations, which is what the Equatorial Fund is called, was established in 2002 as an estimated $165 million in the assets under management. And at inception, when the fund was first created, the fund promised to deposit about 0.5% of all oil revenue that the country produced into a special account at the central bank. Fast forward 2 decades, in 2008, the World Bank confirmed that the government had been putting money into that account. But as early as 2005, the IMF has started voicing concerns that the fiscal rules of the Fund for Future Generations were unclear, poorly observed. And while you might think 0.5%, seems a good start, most extractive-based countries deposit at a much higher rate into their sovereign wealth funds. A good example is Kuwait. Kuwait puts over, is one of the earlier recognized sovereign wealth funds set up in the 1950s, puts 10% of its oil revenues in, which is a huge difference from 0.5%. And the recurring theme that you will see here is a lack of information disclosure. So even though oil is a significant revenue and it is the main driver for the economy of Equatorial Guinea, there is almost no information. So from the standpoint of where we were with this report, we can't say, is money being stolen? Is there money laundering? But what we were able to see is look at the large environment in which Equatorial Guinea operates, including we've had the DOJ in the US has had multiple prosecutions against Equatorial Guinea. Teodoro Obiang, the president's son, they've had houses confiscated in the Miami area. There are similar prosecutions for corruption in France against the political elites of the country. And in that context, what we see with sovereign wealth funds that operate in this opaque environment is that there is no information, but it raises concerns when you see corruption risks elsewhere, but the fact that there is a lack of information. Now, one of the challenges that I will continue to talk about that I want to flag, especially in the context of the FFG fund particularly, is that it is not a member of the International Forum of Sovereign Wealth Funds. The 2019 Sovereign Wealth Fund report card, which is when we were doing this, was the latest year that was available. Equatorial Guinea was ranked the lowest out of all countries. Our authors and the editors and everyone involved in this report could not find any information on the fund's performance. Because these funds operate in a world where there are no public information available, in many cases, we looked into expensive subscription services, some of which can charge you over $20,000 a year just to look at sovereign wealth fund data. There was no information available. We found information on almost every other sovereign wealth fund in the world, but could not find any information on this particular fund. The IMF releases some numbers for Equatorial Guinea, but because the sovereign wealth fund is contained as an account within the central bank and not as a separate entity, the IMF does not break it out. So we still can't tell you what are the specific numbers for the Fund for Future Generations. Sort of passing through these data crumbs, what we were able to notice is that the IMF does report that that Equatorial Guinea has a negative balance on its net foreign assets, even though the government continues to bring in higher hydrocarbon earnings, as the government, rather than safeguarding the funds in the central bank, has continued to withdraw the funds to support government funding. And this for us was a particular red flag, because then it raises the question that the sovereign wealth fund, the Fund for Future Generations, may not actually be fully funded. The lack of transparency overall, plus the combination of well-documented corruption with the governing family, raises like very serious concerns about this, because it is the one fund in this entire report where we could not find any information through paid subscription, public documents, and researchers, even though this fund has been operational since the early 2000s. The IMF itself noted that the country's existing anti-corruption institutions were highly vulnerable to political interference, have very limited resources, and have not been established even by law. Various other surveys on Equatorial Guinea found that its budgetary transparency was limited, 18 out of 100. Transparency International gave it a corruption perception score of about 17 out of 100 in 2022. And I think I use this as a really significant and important example, because the idea that a sovereign wealth fund can guard and safeguard wealth when everything around it, when it is essentially operating, and as we described, in a sea of corruption and poor governance, does not mean a sovereign wealth fund can be set up for success. A sovereign wealth fund is an excellent choice of vehicle only if the pillars around it are strong and it is a strong foundation that actually enables reform. By itself, a fund cannot protect resources, and which is one thing we try to exercise caution, which is there has to be a whole of governance reform before you introduce a sovereign wealth fund. A sovereign wealth fund cannot succeed in isolation, which is something what we've seen in the way sovereign wealth funds are exploded, is they don't work hand in hand. So I wanted to go to my next slide here. Just give me a second. The other thing that I want to sort of touch on, which we look here, is the obvious question is like, for state-sponsored enterprises, you have clear-cut governance norms. You have international institutions that recognize that governance is a real challenge. And so the IMF, the World Bank have really strict norms by which they look at state-sponsored enterprises. State-sponsored enterprises are typically considered by financial institutions for review as higher risk for money laundering and corruption standards. Most countries domestically require heightened disclosure norms around state-sponsored enterprises. So there is a long track record in literature recognizing the corruption and governance risks within state-sponsored enterprises. What is unique is that even though sovereign wealth funds are in essence state-sponsored enterprises of a kind, there is almost no information, and there is limited international scrutiny on them or recognition of their corruption and governance risks. When we went and looked at sort of the international literature and international soft law and standards and norms around it, we realized that almost nowhere is there a connection or a nexus between sovereign wealth funds and the corruption risks or the corruption, money laundering, governance risks, and they're clearly laid out. What you really see, which is at the OECD where this birthed and where you really see standards around sovereign wealth funds and their soft law norms, is they are all articulated through the lens of national security risks and the risk that a country which is a recipient of sovereign wealth fund investment might lose strategic economic assets. So the examination of sovereign wealth funds has traditionally been done through that lens, and most domestic laws continue to operate in that way. The regulation really of sovereign wealth funds at an international level is on a voluntary basis through a body called the International Forum for Sovereign Wealth Funds. Sovereign wealth funds get to do an assessment of themselves and grade themselves. And I think many of us can agree that if you have to grade your own exam and check yourself about how effective you are, there are very few of us that would actually be truly critical of our own homework, if we're honest. And so with the IFSWF, what you see is that you have a lot of sovereign wealth funds here that are featured in our report. For example, we have referenced the Angolan Sovereign Wealth Fund, the Azeri Sovereign Wealth Fund, the Libyan Sovereign Wealth Fund, all of which are members of IFSWF. And I can tell you, having looked through all the scorecards, none of them in their own assessments will say that they have fallen short of the standards that are prescribed by the IFSWF. This is despite the fact that the Angolan Sovereign Wealth Fund was involved in another extractive sovereign wealth fund was involved in a significant corruption scandal. Libya very famously was involved in a corruption scandal where well-known Swiss financial institutions were accused of paying for prostitutes and other bribes in order to secure Libyan sovereign wealth fund contracts, but in turn invested in really high-risk investments that eroded the value of sovereign wealth funds. So you really see that the architecture to govern them is self-regulated, voluntary, and therefore any assessments are quite meaningless. You have other transparency indexes out there, but sovereign wealth funds themselves do not participate in those, nor are there consequences for being higher or lower. Being low on a transparency index or being low or not being a member of the IFSWF does not restrict you or limit you from investing in some of the largest, most advanced economies of the world. So, for example, like Malta, that was featured in our report, is not a member of the IFSWF, but still invests in European economies and in the US through the equities market. What I wanted to show you here is really an evolution of, in the US at least, how our laws have treated the investments being recipients of sovereign wealth fund money. And what you can see here is that almost everything in the US is tied to a particular national security event. So after the Great Depression, we passed the Civil Aeronautics Act. After World War II, we passed the Defense Production Act. When there was a depreciation in the dollar because of major oil price increases, we passed the Exxon Florio Amendment to Defense Production Act. And so if you sort of look at all of this, similarly, after September 11, when Dubai World Ports tried to acquire US ports because they were an investment vehicle through the UAE Sovereign Wealth Fund, post 9/11, we viewed that as a national security risk that a foreign entity would acquire strategic US assets. And you can see a series of this after that, like the Foreign Investment and National Security Act of 2007. At the same time, you see, we passed the CFIUS review, which was to identify and track investments from adversarial interests. All of this is legitimate and needed, but what it does not account for is the fact that sovereign wealth funds in and of themselves and the money that they deploy and the capital they deploy can be problematic in its origins and can be subject to manipulation that does not pose a national security risk in the sense that it doesn't threaten US interests, but it is rather a laundering mechanism and a mechanism for corruption. And that's what we really see is absent in the overall architecture and posture in how countries view the receipt of these funds. I know from talking to Travis and Casey and Tony and Arena that the interest in this presentation is because for extractive funds. But what we have tried to do here is to map out what we see as the way the funds have evolved, the way sovereign wealth funds have evolved. The earliest funds all started off as commodity, but really sovereign wealth funds are an incredibly complex beast and can function in a variety of ways and can be mixed and matched to create truly unique vehicles. So we tried to break it down in, 6 different ways. 1, 2, 3, 4, 5. The 6th one is on the next slide. I couldn't find the space for it. So we could break it down as source of funding, the type, the way in which it is structured, the age of the institution, its objective, its mandate, and its investment portfolio, what it looks like. And as I said, you have commodity and non-commodity. And so the Angolan Sovereign Wealth Fund, ESSF in Chile, the UAE funds are all extractive based. Non-commodity funds are Temasek in Singapore, SAFE in China, BPI France, the Maltese fund, which is featured in the report, and the TWF fund, which is also featured in the report, are non-commodity based funds. You can see that they can be set up in a central bank account, they can be a government-sponsored agency, or they can be an independent public entity, which is, and in that case, they are done through a separate legislation. And some countries choose to do that because arguably that separates it from the government a little bit more and provides you more controls. And the objective is also different. Can be capital maximization, macroeconomic stability, or economic development. Capital maximization tends to be what you describe as like the riskiest of investment strategies. Economic development tends to be then you have macroeconomic stability and economic development that tend to be like lower risk investment strategies you typically see. But even then, I will say, in our experience, there are no clear-cut divisions. The 1MDB fund, for example, was set up as an economic development fund. But the reality was that it was used to just loot and launder money and invest in bond offerings, but that was not the case. And so you really see that unless the objectives are clearly stated, and there are accompanying protocols to match and monitor whether the sovereign wealth fund tracks to those objectives, they are quite meaningless. The other thing is traditionally sovereign wealth funds were always seen as overseas investments. What we're increasingly seeing is that the mandate can also be in purely domestic, which was the case with the Malaysian Development Fund. You can see that the Kazakh Fund and FSI in Italy. And the last bit of it is the type of investment portfolio that you get to see, which is liquid or non-liquid assets. Now, in our experience, just to sort of give you context on this, is capital maximization funds are risk-seeking because they invest in hedge funds, real estate, private equity, and infrastructure, and yield-generating assets to meet their objectives. And this is what happened in the Libyan funds case example, where when they met with financial institutions or managers, they were told to invest in this. And the government in question, because it was part of a larger bribery and corruption scheme that involved, as I said, paying for a whole host of services that do not relate to government activity and do not relate to the management of the sovereign wealth fund, resulted in the government losing a lot of money. The government then tried to file a lawsuit, and they said that we did not have the sophistication to invest in capital maximization assets, and we were defrauded by the financial institution. But the problem is, and some of you may recognize this, is for a lot of us sitting here who are average individuals, when you invest in a mutual fund, there's a fiduciary responsibility because we are not treated as sophisticated investors. But when you are a sovereign wealth fund or a private equity fund, those protections actually don't exist very often in law because you are considered a sophisticated investor and are capable of deploying that kind of capital. And so the Libyan Sovereign Wealth Fund, you could make the argument is that in some ways that they did not necessarily have the expertise and therefore should not have deployed funds, were not capable of making those decisions. But there is also the question of in these situations, what do we view as the responsibility of the managers of financial institutions offering these products to countries, very often countries that are, as you can see, because of the explosion of sovereign wealth funds, are sort of in early stages of development, have still on a primary commodity export stage without coming across as paternalistic and saying that as sovereign nations, they don't have the right to decide how to do this, how to make investments. So it is a really thorny relationship having to navigate it. But what we've seen is that that a lot of these funds that are being newly created in new extractive markets that are just setting it up are better placed because they are not sophisticated investors. Even though sovereign wealth funds are sophisticated investors, the countries and the individuals managing it are not always. And the country doesn't have institutional knowledge to be a sophisticated investor. And therefore, they are better off looking at more, tend to be looking at investments like bonds, treasury bills, investment certificates, long-term fixed income securities in our experience. Now, with all of this, the one example I wanted to give of sort of another example of poor extractives management is the Nigerian excess crude account. This case, the Nigerian case, similar to what we saw, which I described earlier in the three ways that a sovereign wealth fund can be set up, which is as an account, as part of a government-sponsored agency, or as a separate entity. The Nigeria Excess Crude account was set up as an account, similar to what we saw with the Fund for Future Generations. It's set up as an account within a central bank. It was set up in 2004 to protect Nigeria's budget against volatility because of changing crude oil prices. And it has consistently faced criticism because the government has just made arbitrary withdrawals that have really provided tangible benefits to Nigeria. In 2022, the account made headlines because its assets fell from 2.1 billion. Well, let's be honest, it started at 20 billion. It had 20 billion in 2009. And by 2022, its assets had dropped to 375,000. And this was because the government just kept withdrawing money from it because it was just an account in the central bank. There were no checks. They did not follow parliamentary approval because they said they needed to procure assets for the Nigeria's Army, Navy, and Air Force. They paid about $500 million to secure aircrafts for the Air Force. Another 380 plus million was used for various critical military equipment. And there was a lot of criticism around this because they did not receive parliamentary approval. And so one of the things we've noticed in terms of the way you look at reform here is if this is a fund that's set up with an objective for economic stabilization or macroeconomic objectives, or to protect wealth for future generations, then how you invest the money and how you withdraw money for use also has to meet those objectives. And so, and unless it is clearly laid out and it is not in very vague terms, as was the case with the excess crude account, in a case where there are poor governance situations, what you really see is the law allows the government in that there is not enough protections within the law or in the framework that is used to set up sovereign wealth funds to protect against this. Nigeria's own government report on withdrawals from the excess crude account found that it violated the operating principles of the fund. that in this case, the excess pool account actually had no norms written down that would manage withdrawals, how the savings would be used, how money could, what you were going to do with the deposits that were made into it. And then it essentially effectively becomes like a slush fund or piggy bank for whenever you see like, I need something, I can't get approval, I'm the government in charge, let me take out some money. In 2009, the IMF, using the National Resource Governance Institute, which is one of the most well-recognized nonprofits that monitors extractive-based sovereign wealth funds, found that it was the second most poorly governed fund. And this is not something we've seen here. We've seen it in other parts. For example, the Azeri fund, Azerbaijani fund, SOAF, also has been used to bypass parliamentary processes. The SOFAS does not require parliamentary approval, and funds can directly be executed at the behest of the president. What I will say is that unlike the Fund for Future Generations, if you use very expensive, high-price subscription services, like we did in the creation of this compendium, you can track SOFAs. You at least know where the money is going. And the FFG is unique in that there is no subscription service that we could find where we were able to track their deployment of capital. I want to just quickly turn over to non-extractive based sovereign wealth funds, because we see them really exploding and we see really innovative models. At one point, when we were looking at this, we realized that in Bangladesh, they were considering a sovereign wealth fund model that would be based on remittance flows. So they would take part of remittance flows into the country to use it to set up a sovereign wealth fund. And so there were really innovative models out there. The NSDF, the National Development Social Fund of Malta, is one such sovereign wealth fund that was set up, and it is based on citizenship by investment schemes. I should say at the outset, citizenship by investment schemes are not inherently problematic when they are well managed and well designed with appropriate due diligence checks. They can be a valuable source of revenue. The reality is that many places that deploy these do so without adequate protections. And in the case of Malta particularly, the sovereign wealth fund, 70% of it, of money taken through the citizenship by investment scheme, finances the sovereign wealth fund, the NSDF. And this is interesting because then it creates perverse incentives, because you look at this as a primarily, say, revenue generating model, because it has to go into this. The incentive to ensure, because NSDF was supposed to have 4 layers of due diligence checks. But as you can tell, if you read the report, you will see there were notable problematic cases, including Joe Lowe from 1MDB, who tried to apply. He was not given because he failed to meet their due diligence checks, but there were many other individuals that were featured and identified that were considered that would should not have received citizenship because of the serious risks they would have otherwise presented if they were trying to open up and by invest their money laundering and corruption risks would have raised serious concerns. Now, what makes the NSDF particularly interesting is because of its citizenship by investment scheme, it is one of the top, it's among the top 40 sovereign wealth funds in the world by size and volume. The NSDF alone far exceeds, for example, the Vietnamese sovereign wealth fund, even though the Vietnamese economy is about like 20 times larger than the Maltese economy. And so these sovereign wealth fund has been significant. It is also responsible for alleviating Maltese debt and trade deficit. So you can see it can be valuable, but at the same time, because it also sets itself up for perverse incentives, it raises a lot of red flags. Now, as I mentioned, the money from the Maltese Citizenship by Investment Program, which you can see here on this chart, goes into NSDF. And in NSDF itself, it's split into 3 things. It's a discretionary portfolio, an unallocated portfolio and a directed portfolio. The directed portfolio is managed in-house and is typically deployed domestically. The discretionary portfolio is invested overseas, including, as we understand, into equity markets in advanced economies in North America and in Europe. 6% of the Maltese Stock Exchange is through investments that is supported by investments from the NDSF. So what you really see is this structure where the citizenship by investment scheme really supports a lot of it. And because it is going into advanced economies in their stock markets and publicly listed equities, there is the issue that if the money that is used to buy citizenship is tainted, then the money that goes in as part of the investment package is actually pooled money that has risky origins. But at the same time, if you start imposing really strict due diligence checks, you have domestic economic consequences because of its investment domestically into their stock markets. And so you see these knock-on effects really in that in some ways you are, because the money that may come from high-risk origins moves into a sovereign wealth fund, and then from a sovereign wealth fund moves elsewhere, it's almost erases an audit trail, which otherwise, if they were coming as individual investments, you would track them more severely because they'd be associated with individuals that are potentially problematic. The other thing that we also looked at is, and I think this is part of it when I talked about the Libyan example, is sovereign wealth funds. On one hand, you have like rule of law concerns, you have the governance concerns, but you also have the concern about who manages it and also the private sector role and their relationship with sovereign wealth funds. So the Libyan example is as I sort of laid out, is a good example of this thorny relationship in that you can't adopt a paternalistic attitude because these are sovereign states. But at the same time, what is the responsibility of private sector institutions when they deal with sovereign wealth funds? And when you are managing these funds in-house and there are managers, what are their responsibilities? How do you ensure that there are suitable governance checks? So when we looked at it, for example, like the director of the Maltese Sovereign Wealth Fund, David Cormier, and took a look at his investments and companies where he operates, we realized that there were many places where NDSF was operating where he also had a role. And that can be, there may not be anything problematic. It could be perfectly benign and legitimate. But because of that overlap, it creates perverse incentives again. And so you should think of, and then, in a well-governing system, would we argue that you should divest yourself of these interests if you are managing investments? Can the sovereign wealth fund truly invest in a company where the director of that sovereign wealth fund also has investments? So it raises all these thorny issues, and something that we would strongly suggest that if you want a strong framework, you are better positioned to avoid these serious conflicts of interest. The last thing I wanted to sort of touch on before was the Angolan example, which is another extractives-based sovereign wealth fund. Angola established FSDEA, which is their sovereign wealth fund in 2012 with initial capital about $5 billion. It was the only cash infusion that the fund ever received. It did not receive subsequent infusions. The fund was to promote growth, prosperity, and social economic development. And what I would argue in a first governance risk, the president, Eduardo dos Santos, appointed his son, Jose Filomeno dos Santos, as the chairman of the board. Jose then in turn contracted a firm called Quantum Capital that belonged to his close friend, Jean-Claude Bastos, to manage the capital. Jean-Claude had already previously been convicted of a financial securities violation in Switzerland. Files the Paradise Papers in 2017 revealed that, similar to what we're seeing here, in this case, I will say, like in the example of the Maltese case, we haven't really found evidence. based on what we saw in the Angolan case, we raised this as a red flag because these are problematic postures. Bastos just took the money from the Angolan Sovereign Wealth Fund and invested hundreds of millions of dollars in his own companies. And his own company, Quantum Global, received $90 million from the Angolan fund over a 20-month period as part of management fees for the Angolan Sovereign Wealth Fund. The company Quantum Global, which also managed the Angolan Central Bank, was appointed without a competitive tender. When the son Jose Santos was appointed chairman of FSDA, he resigned from his role as the director of an investment bank which was owned by his friend Bastos, who eventually became the manager of the fund. So all of this, these relationships essentially are immediate red flags for conflicts of interest, but the governance norms were never really protected against it. The long and short of this story is, by the end, the case exploded because money was taken directly through as part of a larger elaborate scheme where they essentially faked a BN Paribas letter, and close to $500,000 was wired out and landed up in an account in the UK. And it was flagged by a teller who was curious as to why a mom and pop accounting shop had that much money just wired to it. And it sort of unfolded and revealed all of the problems. And since then, I want to sort of admit that and commend the Angolan government, because they have tried to make serious reforms. But what we see is, it's better off making sure you have strong norms in place prior to occurrences like this rather than after. The Angolan Fund is also a member of the IFSWF, and prior to this had given itself excellent grades in its self-assessment. I just want to quickly talk about policy reforms, and I will turn it over in the next 2 minutes. So when we talk about policy reforms, our recommendation is that, the objectives, as I've said, have to be clearly stated. Is it to manage? What are its objectives? Is it to stabilize the budget? Is it to save for future generations? Because having clear objectives then defines how, helps define deposit withdrawal rules, helps define it, and provide a view into how you look at investment strategies as well. You should have a rule-based investment, which tells you what percentage can go where, which is what we saw in the 1MDB, which they suddenly offered a bond offering, and there was nothing to curtail what percentage of money went where. Similar to what you see in the excess crude account, where they were just able to withdraw billions, and now the fund is left with nothing because it all went into military procurement. Fiscal rules are needed. So it's not just enough that you set up the fund, you've also got to make sure, in many cases, we'd argue that there has to be independence within the government to be able to question it, to have a prosecutor or, the attorney general of the state look into it and ask questions. So they should be subject to a regular audit function, and the results of the audit function should be published. Lastly, and because of time, we haven't gone into this. One thing we realized in doing this is that sovereign wealth funds don't just invest as sovereign wealth funds. So you can pick the amount and say, oh, I can tell it's this sovereign wealth fund. Sometimes they may co-invest, but sometimes they just deploy their capital to a private equity fund or hedge fund. And then it becomes really hard for you to tell if it's a sovereign wealth fund investing. And which is what when we looked at it, we realized it's through those indirect means that sometimes you acquire sensitive technology, but also when it's done through those indirect means, that's how in the 1MDB scandal, they were able to acquire real estate in the US, because it was, and then it's just in the cases in the DoD report, it's acquiring sensitive technology, but in the 1MDB case, they were acquiring real estate and laundering money, but they were deploying it through indirect means, through private pools of capital like private equity. So in addition to structural reforms, just in terms of how an SWF is set up and managed, when they start investing and moving money through the financial system, ensuring there are appropriate checks and balances, that financial institutions also have AML CFT controls, that just because it's a state entity you don't check the box. You've got to look at the state entity, look at the country behind it, look at the corruption risks in that country, and then make a determination. Because in the 1MDB, it never raised a red flag. The money ping-ponged all over the world without raising a red flag. And so we really see these as reforms across multiple levels. But I thought I would do 45 minutes. Clearly, it's not ideal time management, but I'm happy to stay back and answer questions for another 15, 20 minutes. So thank you for your time. And if you haven't, I strongly encourage you to read the report on the Carnegie website and be happy to answer any questions. Thank you.
No, thank you very much, Lakshmi. That was a lot of great information that you covered really quickly. So I think we might be able to go a few minutes over. We only have a few questions on the board so far, so maybe we can try to run through them. I think the one we just got in, I think might be great to cover first, just because of the audience. In your view, what role do Supreme Audit institutions have they played in helping governments to be more transparent and accountable in the management of sovereign wealth funds?
No, I think audit institutions have a huge role to play because, as I mentioned, I think audit institutions, in cases where there are no governance norms around withdrawal, deposits, investment strategies, the audit function acts as that second check. In an ideal world, you would have those norms in place because then it gives the audit function the hook on which to ask the tough questions. Because I think they need to work together. You need to have clear rules set up. So when you do an audit, there are answers that are tied to those rules. And what we often see happen, like, for example, look at the excess crude account case, is that you do an audit function, but because there are no real rules, there is no one, you can't hang that hook on anyone because there were no rules to begin with. So you have to sort of marry the two, I would say.
Makes sense. Rolling back to a couple of the earlier questions, I think the first one we got, and you might have touched on it a little bit, as does the way that a nation structures its sovereign wealth fund and SPE, GSE, or an account impact the transparency and accountability?
So yes, I would argue that yes. I think you have the freedom to set it up in several ways. You can set it up as, like, as I mentioned, a bank account, part of a government enterprise, part of an independent entity. What I will say is that in countries where there are weakened institutions, poor rule of law, having that separation as a separate entity provides just a little more ring fencing, as opposed to just sticking it in an account in a central bank, where we see that then there's the greater opportunity for commingling, essentially. So yes, I would say yes, but I also qualified by it really depends on where it's being set up, how it's being set up. You have countries where it's set up as an account, but there are stronger other institutional norms that provided protection and ring fencing.
Makes sense. The next question is, how comparable is the level of transparency between sovereign wealth funds broadly and other asset management vehicles like hedge funds or investment banks? And really, does it depend on the corporate laws where the vehicle is registered?
No, so you're absolutely right. It's very comparable. And I think that's one of the things that we raised is that why are we treating them as one and the same? Because understandably, private pools of capital and sovereign wealth funds compete in the same space. But sovereign wealth funds have a responsibility to a country and an economy in a way that private pools of capital don't. And so many sovereign wealth funds have made the argument that we shouldn't have transparency norms because it affects competitiveness. But you will have, for example, like the Norwegian sovereign wealth fund, which is the most transparent in the world, which is still the largest sovereign wealth fund. You have the Singaporean sovereign wealth fund, which tends to not disclose any information, but then it operates in a construct where there are general strong rule of law norms, strong governance norms. So I might say that more transparency is better, but I genuinely don't see a world in which that changes. So I think the other option is to making sure that there are strong accountability and audit norms on the inside and strong rules governing the deployment and management of capital into the wealth fund itself.
Yeah, that tracks. The next question is that you mentioned that the United Nations was able to impose sanctions on Libya's sovereign wealth fund. How did they end up doing that?
Oh, it's a great question because because of the civil war in Libya, at the time, Gaddafi controlled the sovereign wealth fund. And so when the civil war broke out, it was unclear which side of the conflict had access to the sovereign wealth fund. So the UN stepped in and said, no one can touch the sovereign wealth fund. And then sometime around 2018 or 2017, there was a concern that no one could touch the capital of the sovereign wealth funds, but the interest payments from the sovereign wealth funds had still been going out, and it was unclear which side of the conflict it was going to. So there was a momentary concern about that, but that's that's how that came to be, why the UN had to intervene with Libya's sovereign wealth fund.
And a quick follow-up of my own thought here is, are there other sovereign wealth fund vehicles that have been sanctioned either by the United States or the United Nations?
None that comes to the top of my mind right now. I mean, I would say yes, during the Russia-Ukraine conflict, the US government at that time did sanction the Russian sovereign wealth fund as well, and its investments into the US at that time. Yes.
The following question is, do you think we have specific laws, I'm assuming in the United States, such as the Foreign Corrupt Practices Act, that would curtail corruption from Wall Street types, would say bribing sovereign wealth funds to purchase investments?
So yes, some countries do have it. And I think so what's interesting is that it's a question of when is it corruption or poor management? I'll give you another very famous example because it's one of my favorite sovereign wealth fund examples. Some of you may remember Nauru. It's a small island off the coast of Australia. They made their money essentially because of phosphate mining. It created a sovereign wealth fund of about $500 million. When I say phosphate mining, it's because the island was untouched for years. Bird poop essentially became phosphate mining. It destroyed the island. The island is unlivable except for an outer ring. Everything in the center of the island is no longer livable. And so they were highly dependent on the sovereign wealth fund. What happened is they got a UK financier to manage the sovereign wealth fund. He, who all his life had only been a banker, wrote a musical on Leonardo da Vinci's romantic life. And the sovereign wealth fund invested a good deal of money into it. As you can imagine, bankers do not make for good playwrights and should not be on Broadway. And so they lost all. So that's a case where you aren't really seeing bribery, but there's a question of also, should you be allowed to make those recommendations? How do you deal with it when it's, as I've mentioned, you can't be paternalistic and tell a government not to do that, but how do you manage those conflicts where you recognize that the people in charge, this may be their first experience directing investments. So in that case, should the laws and norms be written so you can protect against that, to say that, oh, for the first 15 years, you can only do, treasury bills on long-term security, so you don't do risky. Should there be protections built in? And so I think that's, in addition to bribing, that's a second component that I think, at the time of setting up the sovereign wealth fund, you should consider.
A couple of the questions that came in afterwards, after the presentation finished. One is, does the IFWSF have specific norms which have to be followed by the signatories? Are they general in nature? And is there any periodic verification or assessment that the signatories are following these norms?
So yes, IFSWF has a set of norms, but you get to assess yourself against that set of norms. And so every sovereign wealth fund that it's ever assessed has given itself flying colors. The Angolan sovereign wealth fund, as it was going through this crisis, never said, oh, you know what? We have huge conflicts of interest. I have appointed my son to manage the fund, and my son's best friend, who is charging us $90 million, is managing the fund. They didn't admit that. They said, we're rock solid. And so, that's really the problem. It's that voluntary and it's a self-assessment. And yes, I would say that their norms are general and not specific enough. It's not granular in the way an audit function would be.
I see. Yeah. And I think we're coming up on 10 minutes. There's just a few more questions, so maybe we can fly through the last ones. So you have the example of the Malta Sovereign Wealth Fund, where it controls 6% of the stock market. What laws can be placed in place to ensure that the investment for the citizenship program is not abused?
So typically what you do is then ensure that, there are strong due diligence checks. So a lot of citizenship by investment programs, ask you to verify source of funds. So if let's say I want to invest, then you invest in Malta, or in the US, you have the EB-5 scheme. You have to just you do checks to make sure, okay, where is my money coming from? Is my money coming from legitimate means? I should not be the head of a drug cartel and be allowed to, buy into it. Typically, a lot of citizenship by investment schemes have a residency requirement. So making sure that you actually meet that. So I think at the back end, it's fine if you want to choose to set up a sovereign wealth fund this way, but ensuring that you have due diligence checks on the back end, especially on source of funds, and doing a deep dive on that makes a huge difference.
This one I think is obviously going to come up. So the United States president has floated establishing a U.S. sovereign wealth fund. Any thoughts on what it might look like here?
I mean, I've heard the idea. In the US, we are at an advantage because we have great models at the state level. Texas and Alaska are incredible models to follow. They are long functioning. They've been successful at preserving wealth that has come from the extractive sector. And so I think those are models. So we have a good model to follow. But again, as I said, like sovereign wealth funds can take so many different types. I'd be eager to see what the plan is, where we're going to get this, what will fund it, how we plan to deploy it, what the aims are. I'd be interested to hear it as it develops.
And I think we've got time maybe just for one more. I want to make sure I don't get cut off abruptly. I'm not sure quite how the Zoom cutoff works. So do you have any examples of sovereign wealth funds used for money laundering? And do you have any cases that have actually led to convictions?
So the 1MDB is a great example where it led to the DOJ led to a conviction. It didn't happen in Malaysia itself, but the DOJ went after them, even though it was a global scheme. At that time, they stole over like $4.5 billion, and a lot of it was invested in the US. Wolf of Wall Street was financed through stolen money from 1MDB. And so when the DOJ convicted them, 100%. There was money that was stolen from the Angolan fund, which was also forced them to cause like structural reforms. So yeah, we do have examples of actual action, but we also have examples of no action.
And I got word that we were not going to get cut off, so I'll go ahead and read the last question that came up here. Why have these funds had no immunity? We know that certain amounts of money are sometimes used for crises or other than for future generations. I'm not quite sure what that's getting at, but can you, any thoughts on that? I think
Can you just repeat that last question?
So I'm assuming it's asking, why are these sovereign wealth funds, why do the sovereign wealth funds have no immunity? And we know that certain amounts of money are sometimes used, let's say, to respond to crises other than for future generations. Okay.
Absolutely. You're absolutely right. Funds can be used, like when you have that's what when you say they're used to preserve, so it depends on what the objective of the fund is. If the fund says that its objective is to preserve for economic stability, 100% you can redirect those funds for a crisis at times of crisis. If the fund is only meant for future generation, so you've got to be really clear about what those objectives and therefore how you can use it. So if it says you can use this to preserve economic stability in the times of crisis, then there's a question of what percentage can you withdraw? It shouldn't be an easy piggy bank that you can draw from every time there's a problem. There should be like, is it 2%? Is it 3%? Do you have to sell other assets? Are there other means? It cannot be like a convenient grab bag every time you have a problem. It has to be structured in the construct of, if there is an economic crisis, what else can we deploy, and therefore what role will sovereign wealth fund play? Otherwise, you will end up with a situation like you see in Nigeria, where you start with 20 billion and then you're left with 300,000, which is insane.
Well, I think I speak for everybody when I say this has been really fantastic information. Your presentation style was a lot of information, but also very clear. I think it's probably time to wrap up. I'm pretty sure that was the last question on the list, but thank you so much, Lakshmi. And for everybody else online, if you weren't able to catch the whole presentation, we do hope to be able to present it at a later time for the recording for future viewing. Again, thank you on behalf of everybody at GAO and everyone working at Intosci, and we hope you have a fantastic day.
I don't know if you're going to get cut off, but I just wanted to also thank all of you for organizing and helping manage.
Lakshmi,